Every time you turn on the tap, you are interacting with the single most vital resource on Earth. But for the people managing the pipes, those droplets represent a highly engineered, relentlessly efficient asset. This chart shows exactly how lucrative that asset can be. In 2025, Maynilad Water Services reported a 19.1% surge in net income, closing out the year at 15.2 billion pesos, and the momentum is accelerating. In the first quarter of 2026 alone, they pulled in another 4 billion pesos in net income. That cash flow is powered by a captive market. Over 10 million people across Metro Manila and Cavite rely on Maynilad for daily survival, with no alternative provider to choose from. A monopoly driving double-digit profit growth usually relies on aggressive price hikes or a rapidly expanding customer base. However, Maynilad's build connections rose only 1.5%. The real engine behind this wealth is an internal operation to fix a massive, invisible engineering failure hidden right under the streets. By focusing on this invisible infrastructure, the company has aligned its engineering goals with a specific financial framework, turning routine maintenance into a high-yield corporate engine. To understand how that engine works, we have to look away from corporate spreadsheets and focus on the vast grid buried beneath millions of homes. Utility companies track a metric called non-revenue water, or NRW. This is treated, clean water that vanishes from the system, lost to cracked pipes, leaks, or theft before it ever reaches a paying customer. For decades, this was a constant drain on the balance sheet. Millions of liters of processed product were pumped straight into the dirt daily, generating zero revenue. To stop the loss, it launched a massive counteroffensive. In 2025, they executed 26.9 billion pesos in capital expenditures, the highest infrastructure disbursement in their history. That money funded aggressive network upgrades. They developed new water sources, hunted down subterranean leaks, and expanded their wastewater treatment coverage to over a quarter of their territory. The physical results were immediate. They drove their average non-revenue water down to 34.9%, recovering 256 million liters of sellable water every single day. By spending billions to plug their own leaks, Mint effectively manufactured a massive new supply of product out of thin air, ready to be billed to that captive market. Recovering that lost water is only half of the equation. The real secret lies in the complex financial architecture of utility regulation. When a regulated utility spends billions on infrastructure, it legally expands its regulated investment base. In this system, the more they spend on pipes, the higher their baseline for allowed profits. This graph illustrates the impact of capital spending. Maynilad's internal cash position, the internal estimate of their investment base, jumped 63%, reaching 163.9 billion pesos. This larger baseline forms the foundation for a legally regulated 12% pre-tax nominal rate of return. Combining this expanded base with the efficiency of recovered water causes the margins to soar. Cash operating expenses barely moved year over year, pushing their EBITDA margin to 69%. When you factor in the depreciation from all those newly installed pipes, their adjusted net income for the year reached nearly 19 billion pesos. This flywheel transforms infrastructure spending from a typical business expense into a regulatory lever that raises Maynilad's guaranteed profit ceiling. The cycle is now complete. The manual labor, the repaired pipes, and the expanded rate base all culminate in a massive payout for shareholders. This pie chart reveals the scale of the reward. In early 2026, the board approved a cash dividend declaration of approximately 8.44 billion pesos. That distribution exceeds the company's minimum policy commitment, signaling the absolute strength of their cash generation and their confidence in the long-term capital program. This is a sophisticated financial loop. Maynilad deploys billions to fix its own network, secures a 12% return on those investments from a captive market, and converts recovered water into 69% profit margins. Yet, beneath the accounting and the billions in dividends, this entire economic engine runs on a single reality. Every customer connected to those pipes needs that water to survive. When a private monopoly is granted total control over a region's most vital resource, we have to ask, who is this financial machine actually built to serve?